Good evening, everyone, and welcome to this webinar. We're looking at what's in store for 2026. I'm Chris Beauchamp, Chief Market Analyst for IG UK, and I'm joined by Axel Rudolph, our Senior Technical Analyst. Good evening to you all. Thank you for joining us. Just a few housekeeping notes. I think you should all be able to hear us fine. We were talking to ourselves before, and I think it was, according to my microphone, it says it's all working fine, and you should be able to see my screen. You're all muted as a matter of course, but if you've got questions, pop them in the chat and we'll probably get through them at the end. Thank you, Rufus. It's good to know that somebody can hear me. And then if you prefer at the end, raise your hand and we can unmute you as and when you ask a question, which if you might prefer. Up to you. Either way works for us. But for you all muted, just so we don't get any extraneous noise. We aim to go for about, well, we've got a full hour. You don't have to use the full hour. We'll probably aim to talk for about 45 minutes, I expect, switching between presentation and charts, and then do questions at the end. We'll see how we go, though. If we start getting lots of questions in from the beginning, maybe we'll try and skip through just bits to make sure everyone gets a chance to ask questions who wants to. But thank you all for, as I say, for joining us. We should be expecting a few more, but I'm sure they'll trickle in as we go along. So the title of this evening's webinar, What's in Store for 2026? I thought it might be useful if we started off just with a review of the year that was, because it's probably one of the craziest years I've seen. Axel, I'm not quite sure what you thought of it, but certainly it's having started off, as I say, with US exceptionalism. If you cast your minds back 12 months, if you can go that far, you had, Donald Trump was newly elected, but yet to take office, all the expectations around that. And there was talk of how US markets were the only game in town, and that to not be long the US or not be invested in the US was a very dangerous strategy because you would miss out on these incredible gains. And then, of course, we had March and April, and the market was already weakening broadly as we went into March, and then really had a nasty slump, obviously, around Tariff Liberation Day. But what, of course, caught everybody out was the way, if I can skip slightly in my list, stocks just rebounded so quickly. The sheer scale of the tariffs was a shock, but equally shocking was how quickly it changed, and almost as if it didn't drop off the radar entirely, but really it seemed to be discounted very much through the rest of the year, and the word tariff became mentioned less and less as the year went on, and how resilient markets were. Now, of course, we should note that last year, and we'll come to this in a while, is how US markets did well, but because of March and April, they actually underperformed a lot of their international competitors, including for the FTSE 100 for the first time. So we'll certainly cover that. We also had a slump in oil prices, which came despite a conflict between Iran and Israel that lasted for all of about 12 days, but nonetheless, to see those headlines actually come through was quite remarkable. And yet oil prices, they did react initially, then continued to fall into the rest of the year, and they're dropping as we speak right now. You also had the surge in precious metals, becoming quite a mania almost. In fact, if there was a bubble last year, you might argue perhaps the bubble was in silver, perhaps not so much in AI, but we'll come to that as well. And then the slump in crypto prices towards the end of the year, and as the year turned, we had the Fed cutting rates once again, and really the Bank of England cutting rates as well. And now from today's inflation readings from France and Germany, it looks like the ECB may also perhaps join that party as well. Axel, what was your view on the last 12 months?
Well, as you said, Chris, I mean, I was very, very surprised by the V-shaped reversal we saw in April in US stock markets, with those shooting up and then, making double-digit gains, which is really, really extraordinary, given that these tariffs are still in place all over the globe. So that was my big surprise. I was more like, I guess, an institutional investor in that I was more cautious going long, and the retail clients actually got it right last year by just going long in April and just staying long and buying even more stocks as the market was going higher and higher and higher. You're on mute, Chris.
Yeah, seamless, isn't it? What about, I think the gold and silver is perhaps the other remarkable thing of certainly the last quarter of 2025, isn't it?
Yes, I mean, silver was a huge surprise. I mean, it's shooting up to $84. I don't think anybody could have foreseen. There was also at the end of the year a very sharp up move because of speculative pressure. There was a lot of social media hype going on during our Christmas period in Asia. And in China, investors were just blindly buying, well, I shouldn't even say investors, traders were blindly buying silver, which is why it shot up to $84. But then as soon as the UK market came back on the Monday after Christmas, we had an 11% drop in the silver price. So that dragged all the other precious metals down with it. Gold came off again, and copper as well, and platinum and palladium as well. But if you look at the beginning of this year, we're back up again and we're heading towards the all-time highs.
And poised for US earnings season as well, which is undoubtedly going to have an interesting effect on where we see markets going. I think how we're going to divide this up is we're going to work through things sort of by asset class, although I've broken them down slightly, but we're going to start with the most popular part of markets at IG, which is indices. They're by far the most popular amongst IG clients in terms of their exposure, although generally they're on the most popular. I think we should talk about how US stocks had, it's interesting because it actually was a great year to be in US stocks. But the problem is, of course, had you said in January you should go massively long the US, or had an investment advisor suggested to be heavily invested in the US, shall we say, they'd have been right in the end. But it was a year in which the journey perhaps was almost more important than the destination. And it was the shock of tariffs, it was the way they were calculated, it was the sheer breadth and depth, and obviously, perhaps most importantly, the sheer scale of tariffs on China, the most important trading part of the US, to the point where at one point it looked as if there was no trade at all, certainly no official trade between the US and China. A lot of it was going through other countries, as the year certainly showed. But after the initial drama around tariffs and their imposition and the way they were calculated and the fact that they seemed to have tariffed everybody, including islands inhabited solely by penguins and other countries that had very fair trade practices with the US, the way they'd done it seemed to certainly catch people on the hop, and markets didn't like that. Markets, a great lesson in markets, hate surprises. We knew tariffs were coming. We didn't think they'd be imposing quite the way they were. But of course, nonetheless, you had this incredible moment whereby the dip became real in so many ways and seemed to become the investment theme of the year. And that was backed up by the other great theme of certainly the first half of the year, which was the taco trade. Trump always chickens out, where you had the administration seemingly reversing course on tariffs entirely and pausing them for 90 days and then engaging in a series of deals that, whilst not trade agreements in actual fact, were essentially trade agreements in name, and seemed to put to bed the issue of tariffs. I think for Axel, you must have seen a few mad years in your time, but April and May, or certainly April, and that one day where markets rebounded by 10% must have ranked as one of the craziest you've seen in a long time.
Yes, definitely. I mean, it reminded me of 1987, except that we didn't get the bounce back then. Yes, it was very, very volatile. And the question now is, are we going to see something similar this year? Because if you think that we are going to see a fourth consecutive year of double-digit gains in US markets, it may happen, but it's extremely rare. So what could be the flip side of that? Well, we could see corrections. I believe it was Goldman Sachs who said that we're extremely likely. I think there's an 80% chance of seeing at least a 10% correction each year. So we haven't seen one of those for a while. I mean, in November, we had a little bit of a blip, and everybody was quite worried about it being a big bear market, but it was just a normal correction in an uptrend. The question is, in a year where we have midterm elections in the US, will we see more volatile markets going forward? Will we see 10 or even, I don't know, potentially 15% corrections, or will we see what a lot of people seem to be expecting, a bear market? But right now, if you look at the charts, they're still pointing higher.
We could use that to segue seamlessly. Perhaps your chart. Should we look at the Dow first? Do you think, Axel? Perhaps.
Yes, if we do that, I mean, the Dow, for those of you who follow our trade of the week, it was my trade of the week on Monday. So we went long down here somewhere. So we're already up 500 points or so, or even more, 1,000 points now. It's gone up another percent today. So yes, the Dow really taking the lead here from the Nasdaq, because we saw at the end of November a rotation out of AI stocks and technology stocks, so the Nasdaq mostly, and into the sort of industrials and other big companies in the US, which are part of the Dow Jones Industrial Average. And yes, I mean, for me, this chart speaks volumes, because basically what we've seen is a breakout. We saw the same happening today in the German market, in the DAX 40, breaking through, making new all-time record highs, and doing so with these big candles, with volume. And now we're probably heading towards psychological resistance here with the Dow, and that's for me is 50,000. It's a round number. We saw the same with the FTSE as it hit a new all-time record high just above 10,000, again a round number. And in the short term, at least, all of this looks pretty positive.
And this is, I think, what's that pullback in November? Is that sort of like is that 5, 6, 7% we had? I think for the Dow, if we take that as an example.
Yes, I mean, it wasn't, yes, something like that. It wasn't anything major.
No.
And the Dow actually held higher here than it did at the end of October or in the middle of October, whereas if you look at the Nasdaq, that dip was more pronounced, as you can see here. So that's the Nasdaq, and we retested and actually went intraday below this low from the 10th of October, but didn't close below it. So that's why it's always very important, if you're a technical analyst, that you look at closing prices, not just intraday movements through a price level, because that can often happen, that you fall through support intraday, but then you close above it again, and that means it's still a valid support level, and it held the market here. And from there, we saw a very nice up move, and you can see the Nasdaq also heading higher. But if you compare that chart to the one I just showed you on the Dow, you can clearly see that we're struggling with regards to the Nasdaq. Yes, we're heading back up towards the highs seen in December, but we're still a little way off our record high from October. Whereas if you look at the Dow, clearly making new all-time record highs, big candles to the upside, and the S&P also just now making new record high above that seen in December here, as you can see on this chart.
And it is interesting, isn't it? Because 2025 was a year when the word bubble was bandied around a lot, particularly with respect to the tech markets, Nvidia, and the question of overvaluation came through. But it is certainly interesting to see that you have the Dow, which is as a smaller weighting in tech compared to the S&P, is actually doing better at the moment than the Nasdaq. And I think if people are sort of sitting there concerned about whether this is a bubble, I think, if I put my cards on the table, I still sort of lean towards the no, it isn't. I'll come to that in a second. But I think if you do think it's showing bubble signs, the fact that the Dow, which is more of an, if you like, an old economy index, if we can put it like that, it's more heavily weighted to banks and healthcare firms and industrial firms, as the name suggests, it's probably a good thing. And this is natural market rotation. We had a period where the Nasdaq was so clearly leading the way, and then over the past sort of, certainly in December and into January so far, it's been the Dow, as Axel was saying, that's really outshone the Nasdaq particularly. Should we just quickly look at the Nasdaq while we're here? I think because spend some time on indices, we need to go through some of the European ones. But it's really interesting that you actually, towards the latter half of the year, Nvidia, which was the star of the first half of the year, certainly, and in the years previously, gave way to Alphabet, particularly, which was a company that people had thought would be doomed because of the AI move. But as you can see, Nvidia there, still, and indeed most of the Mag 7 actually still quite a way off previous record highs, which is probably a healthy sign that this market isn't being driven solely by those bigger stocks, is Axel?
Yeah, I fully agree. And the question is, are these tech stocks going to hold at their support levels, which for NVIDIA, for example, are these lows here? You can see going back to September. So anything between sort of the July, the September lows are the big important levels here. We've got some good support where we held in mid-December here, just around the November lows. So if they were to give way, then perhaps we could form some sort of top, but right now that is definitely not the case. If you look at Alphabet, you can see that we are looking more positive here. As you can see here, we are still in a very clear uptrend. And yes, short term we're consolidating, but the trend looks very healthy, and it's more likely to continue than not. And that's the thing that a lot of people don't seem to see, is basically when markets make new record highs, or when individual stocks make record highs, then we're quite often tempted to sell against that, thinking it surely can't go any higher, it's now too high. But there is a reason why it's going up, and the reason is more people are buying that stock or that index than they are selling it, and therefore you've got momentum driving the price higher. So unless something changes from a fundamental point of view, or you have a big technical reversal to the downside, more often than not, the previous trend is likely to continue.
It's been a big week for round numbers and record highs already, and it's only the 6th of January. We should talk, Axel, if you can drag out the FTSE from your chart library while I talk over it. It's just talking about earnings season, which starts next week really in earnest, with JP Morgan, US banks kicking off as they normally do. The expectations for that, and you can read more about this on the website when we publish our report later in the week, but the expected earnings growth rate for the S&P for Q4 would be 8.3%. And if that is the actual growth rate for the quarter that's achieved, it will mark the 10th consecutive quarter of earnings growth. So when people say or discuss, are US stocks in the bubble? Is the US too expensive? Is it overvalued? These are the kind of things you have to look at to see, do earnings justify what they're looking at? And particularly, I think if you look at things like profit margins for US markets and US stocks, they are so much more profitable than many other markets that there's the reason why they trade at these higher multiples. Essentially, it's a quality level. Yes, they trade at levels in terms of earnings and valuations that we've not seen since things like the financial crisis and since 2000. But the earnings growth is there, the margins are there, and it is simply the fact that investors are being asked to pay a premium for quality, whereas say for the FTSE 100, which is plenty of decent companies in the FTSE 100, and of course it did outperform the S&P last year, but it doesn't have that same level of profitability, which is why it trades at a lower multiple. There's less demanding expectations around earnings compared to the US. But to be fair to US stocks, they do continue to meet that. And of course, as Axel will take us through the chart, we've had a breakthrough this psychological level of 10,000, which is, it's just a phrase. This 10,000 is no more important than 9,999 or 10,001. But because it's a round number, it does tend to sort of evoke an emotional reaction from investors, doesn't it, Axel?
Yes, and that quite often is the case, that we gravitate towards these round numbers for that very reason. And that's why if we look at the Dow again, I wouldn't be surprised if we hit the 50,000 mark, and we're very close to it now already. But the question then is what's going to happen around here? Because if you look at the FTSE, we for 3 days traded around the 10,000 level, and now we're breaking above it for sure here. So that's actually quite positive, because if the market were to fall again, that support will more likely than not now act as well at that level, basically as a support level. Again, because it's a round number, together with the high we saw here back in November, and that was around 9,930 or so. So if you look at the trends, you just, very simple technical analysis, use that and just look at the trends. We have a series of higher highs, higher lows. And we've had these for, since April, really. And there is no reason to believe that this will change unless we see a big reversal. And what we saw in November was a short-term reversal. But again, there, can you see here, we didn't fall through the previous lows. And that's what I tend to do. I look at sort of where the last reaction lows compared to the chart now. And, they're a long way away. So, yes, round numbers are important. The question for the S&P, for example, is, yes, 7,000, that's the next round number, but 10,000 is sexier for people, but 10,000 is a much bigger move. So are we going to see something like that again this year, which I said before would be a 4th consecutive year of double-digit gains in that case? Or are we going to see perhaps what we saw, I think it was 2016, 17, I can't remember now, but, where you have a good start to the year, but then you do get into a lot of volatility, and you have, swings, ups and downs during the year.
And I think you probably need to move on to our next asset class. I don't want to talk over too much. But it's interesting that, I suppose as an investor, you have to ask yourself, Obviously, it's gone up a lot. It can go up more. As we flagged earlier, that we haven't seen a substantial pullback since April. Actually, it's getting on towards a year now since we had a meaningful pullback in stocks. We had a Q&A this morning we did on Trade Live with IG, which discussed this. One of the questions we asked was, well, what happens if we get a 25% pullback and what that means for markets? And it is possible that you get that. And we are essentially probably closer to the next one than we are to the last one, if you like, in time. But even that, assuming I think everyone always thinks that the next big sell-off will be the beginning of another 2008, but the likelihood is, famous last words, it isn't. But if you do get some volatility, and I think we should be expecting some, certainly within the next 6 months, then it will probably be more of a dip within a broader bull market that's powered by earnings, rather than just expansion of multiples and simply froth and euphoria, really, I think is probably the way to look at it. So yes, it's understandable people look at the chart and think it's gone up so much, surely it can't go up anymore. These record highs are being hit all the time. But bull markets last a lot longer than bear markets, and they deliver bigger percentage returns than the losses seen in bear markets. And if you look at April and May as sort of the reset of the exuberance of 2023 and 2024, this could have further to run. Anything can happen, of course, but at the moment, as Axel says, the price action doesn't show much sign of slowing, and the fundamental outlook as well doesn't really either. We should push on, I think, so we don't get accused of talking out the time. We will go and do precious metals now, I think, because that's probably the next area where certainly mania really came into the fore, particularly in the last month of 2025. But the rally in gold and silver and these other semi-precious metals too were remarkable. And it was a question of why this is happening. And certainly I think by Q4 it had turned into momentum trades. People were simply jumping on the bandwagon simply because the price was enjoying such a strong run. But you did have famously, the FT ran a headline where they actually used the word FOMO, or the term FOMO within the headline, fear of missing out. But I think it had its roots in substantial central bank buying of gold, some concerns about return of inflation, and also, as Rufus has discussed in the chat, possible as the debasement trade, the weakening of the US dollar, making commodities more attractive. And so this is why you had this huge flow into gold, and it seems to be continuing as the year starts. And if we take sort of the next step from gold and silver, is gold and silver miners. Fresnillo was the best performing stock on the FTSE 100 last year, rallying by I think it was 180% by the end of the year. Clearly, as an investor, you probably look at that and think, gosh, why didn't I buy Fresnillo at the beginning of the year or earlier? But other miners did well too. In fact, it seems to be copper seems to be the next metal that is poised to take off because demand is looking very, very strong. But I do think if it probably, and certainly silver has demonstrated some of that already, that it is due some volatility. Now, that's the kind of thing analysts have to say after it's gone up a lot, because it makes it sound sensible. But it's a sensible thing to say, because you rarely do see these rallies go on in such a quiet fashion forever and ever. But the fact you had gold clear 4,000 and now start to be really eyeing up 5,000 as the next target suggests that a lot of these gold miners and silver miners will also do very, very well, because they'll continue to be, their cost hasn't gone up necessarily, but their actual profits and their margins are likely to increase. And it's actually showing us there on the chart, the trend yet again is still very much intact at this point.
It is, and what is interesting is, even though we saw this sharp decline I just mentioned on the first Monday after Christmas in the UK from the Asian session here the day before, we are basically nearly back to where we were just before that drop and heading towards record highs. And again, round numbers are probably important. I wouldn't be surprised if in the course of this year we are going to hit $5,000 per troy ounce with regards to gold. If this trend continues, of course, but also the fact that we've just had this sharp decline during the festive period when, volatility can be very high because volumes are lower, because a lot of people are not trading actively. then it's actually very surprising that we just come back so quickly and ignore what went on here. So we haven't seen something like what we saw at the end of October here, where we continue to fall for several days before sort of leveling out and then heading gradually higher again. So the fact that we are sort of moving up with these bigger candles is actually quite positive, and it looks as if we are going to continue to head higher. And what is interesting is you would expect gold, I mean, a few years ago, you would have said gold comes off because it's a hedge. Equities, go up, gold price doesn't really go up that much. Yes, obviously it depends on the dollar weakening or not. But what we're seeing at the moment is we've got risk on sentiment in most asset classes, perhaps not in crypto, but of course, even there, last week we had, a rise. But anyway, what I'm saying is equities are going up, and yet the gold price is still heading higher because, as you said, a lot of people invest in gold still, and also central bank buying is very, very important. And a lot of countries seem to be moving into gold because they don't want to be as dependent as they are at the moment on the US dollar.
And I think it's interesting as well how if you go back to gold, if we zoom out further, in the way that you had actually going back into, and I'm just trying to see it on the chart there, a bit too far. So sorry, I meant to see back into there. That's good. That consolidation we had in the middle of 2025 was, if you like, the digestion of those huge gains. It's a reminder, of course, that even the strongest trend can go through these periods of weakness, and then when it breaks out, as the DAX is going, not to go back to indices, but the DAX has done now, it can be quite dramatic, can't it?
Yes, definitely. So what we could see, and it could last years, and not just several months like in 2024 and 5, where the asset class just goes sideways. And we saw that in the case of the DAX, as you can see here. So the DAX had a nice up move. This is the April decline, then a nice up move. But where it went sideways is basically all this phase here between June of last year and basically December. So between June and December, we just went sideways. At the same time, the FTSE made an all-time high. Asian markets made record highs. US markets made record highs. So the German market didn't, and then it continued to go higher. And now it's breaking up and it's making new record highs here. So with regards to gold, we may see something similar happening to what we saw in 2025 here, that sideways trading range. Once we make this new all-time high, maybe it's going to happen on the way towards the 5,000 mark, who knows. But yes, you do have trends which are also just sideways trading trends. But right now, it clearly looks more momentum-based with regards to trends going up than any sideways trade. And the same is the case for silver. If you look at silver, so this is the 11% decline I talked to you about on the 29th of December. But again, I mean, look at it. We've nearly made up all of that loss, and we seem to be heading towards a new record high. So what target could we have for silver? Again, a round number, probably $100 per troy ounce. Something that if you mentioned that last year, people would have said, well, you're crazy, because at the beginning of last year, we were trading at $30. So a huge advance here in silver.
And it is, of course, so much more volatile than gold. And that brings with it its own trading risks, as we saw last week. And actually, we might probably look at it more in the context of people being long silver and seeing this sharp decline. But I'm sure there was probably quite a bit of action on the short side, people actually looking to think this is it for silver, that the bubble has popped, the gold silver ratio is high, it can't go any higher. It's kind of sort of the corollary as we have for earnings and valuations, people saying it can't get any more expensive. Well, it seems it can. But equally, then you had the swift drop. But the rebound has not been as swift. It obeys the rule that markets tend to rise 3 times slower. So they fall 3 times faster than they rise. So it takes a few days to claw back the one-day loss. But again, it's how resilient it has been. And so often these trends do come back again. People are constantly looking for those turns because it's the one. It's we can talk about Michael Berry, because he popped up again in 2025 saying that AI was overvalued, it was a bubble, and because of who he is, it gets so much attention. But the actual fact is that trends, in many cases, do have these pullbacks, and they could be dramatic. But then often the trend reasserts itself. The fundamentals, if you like, for there, people buying precious metals, something like debasement, yes, something like central bank buying, hedge against inflation, all these kind of things. And a simple momentum trade, you can't underestimate that. It's people simply jumping on board what is clearly moving. It just reasserts itself and it continues to go from there. So I think, again, it has been, even for silver with the end of year volatility, it has been quite quiet. Remember how volatile silver is. So the risk is looking ahead from here, that you do also then get further volatility. I think it's highly likely, isn't it, Axel, from this point, that some volatility has to occur over the next 6 months or so.
Yes, I mean that's pretty likely, and sometimes you can spot a top forming when that happens, when you get increased volatility, these big candles up and down, and the market sort of swinging back and forth for a while and then topping out. But for a market to top out, what you need to see is at least either a lower high. So if we were to top out here right now for the moment, at the moment, for example, or if we make a slightly higher high and then top out, and get a sort of negative divergence on the oscillators here at the bottom of the chart, then you can say, okay, maybe we can form a top if we fall through an uptrend line. But we haven't seen any of that. I mean, you can clearly see we still have a series of higher highs, high lows, and the upturn is still very positive, despite that 11% drop we saw on the 29th of December. So yes, momentum is far more important than one or two candles on a daily chart.
We should move. Ideally, we'd cover, I think, palladium and platinum, but there's a similar picture, isn't it, really, for this point always? We should move perhaps onwards to oil and natural gas, because there's plenty more to cover there. Oil as well, the big year of, the big event in oil prices was the fact that they seemed so impervious to geopolitical events. Iran, Israel, expectations of demand picking up really didn't materialize. You had essentially a supply glut, really, throughout the year that provided this drumbeat of declines for oil prices. For natural gas, it was a slightly different story. We'll come to that in a second. You had two big rallies over the course of the year that fizzled out, and it seemed like towards the end of the last year we were poised for a big rally in natural gas, and that hasn't happened. What is interesting, though, if you look at things like the monthly fund manager report with the Bank of America, where they survey fund managers, they ask them what they like, what they don't like, what they're worried about, what areas they're overweight, what areas they're underweight relative to history. What is coming through now, and has come through for several months, has to be said, is that they are underweight energy because of the underperformance of oil, because of the weakness in oil stocks. Now, you've had obviously a very good week for US oil companies, and if you look at things like commitment of traders and the sort of positioning, it's certainly the case that people have, just as they've jumped on the rallies in gold and silver, they've jumped on the declines in crude oil, to suggest that expect that there'll be further declines. And it's possible that it's certainly in the short term, we do have perhaps some over positioning on the bearish side of the equation. Certainly investors, fund managers are underweight energy stocks themselves, mostly because of the poor performance of oil, and expecting things like the US pushing more for oil production to lower gas prices to help the economy, continues to be a possible bearish headwind for the sector. But I think as oil is down another 2% a day, isn't it? Or it was this afternoon, Axel. I think it's further weakness perhaps coming through here.
Yes, I mean, if you look at oil, as you've just said, I mean, there's not that much demand. There's mainly oversupply, hence the downtrend that we've seen over the last year. And you can see here, even though we bounced back on these geopolitical events to do with Venezuela yesterday, today we're just reversing that once again. And here the trend is your friend. Again, you see a series of lower highs and lower lows. If I zoom out even further, you can clearly see that from the high we saw back in June, we've clearly entered another bear market and are heading lower. The question now is, can we hold at these lows we made during last year around the $55 mark? So we're talking about the April lows here, more or less tying in with the May lows, and also these lows here from October and December. Because as long as these hold, we may have a sort of bottoming formation here and then come back again. But even then, how far could we go to the upside? Well, you've got a lot of lows here going back to 2024, and a lot of highs here tying in at similar levels. So around the $65 to $66 mark you probably would encounter resistance if we were to bounce back from these lows here. The real question for me, though, is can we actually fall further? And I do think that is a distinct possibility, simply because there's so much supply. And if that were to happen, and if we were to fall through, for me, the December low, the mid-December low is the sort of the line in the sand. And if that were to happen, we could quite quickly not just fall towards $50, but in my opinion, it's also possible that we may actually retest the $40 mark. I think some analysts even talked about $30. I think it was even JP Morgan, wasn't it? But there is a possibility that we could actually head lower, because it doesn't mean simply because we're holding here in the short term that we are going to find a bottom here and reverse, because the trend is still pointing lower.
I think it just to sort of speak to the point about positioning is the fact that if you do have a broad bearish positioning, it tends to mean that prices will fall further, but there is always the risk that in the course of the journey, you do have these sharp snapback rallies. And I suppose with oil, it's particularly a geopolitical thing. It's driven by Iran, Israel, Ukraine, now Venezuela as well. So it's just as ever with investing and trading, be prepared to accept the fact that sometimes the journey is more volatile than we expect. And whilst your view that it will continue to fall could be correct over the longer term, if you do get these sudden spikes, it can catch people out, particularly on the short side, I think, because you have these famous short squeezes where suddenly the price rallies, and it's just the possibility. So at the moment, yes, I think you have to stick with the trend, and I think particularly from a trading perspective, is the way to go. It is just the risk that because you've got this bearish positioning in crude oil, in the commodity itself, and also this widespread skepticism around energy stocks, that it could continue to put pressure, upside pressure, at least in the short term, in crude. And we had these brief, sharp rallies. We've seen a number of those over the course of the last 8-9 months, and then the trend resumes. But as ever, the journey can be more volatile than we expect, and that's a lesson to take for equities as well. Just because the overall trend is higher doesn't mean you don't get disruptions along the way. We should quickly look at natural gas as well, because I mentioned it in the slide. Perhaps it's another one where we've certainly seen it tends to be a much more volatile one than oil, I think, doesn't it, Axel?
Yes, and what I love about this one is it charts extremely well. I mean, why am I saying that? If you correctly draw your trend lines, I mean, you can see here I did so from the August low through the low in September. That uptrend line was broken, and then we had a retest of that line, and then we went down, and then we retested it again, and it acted as resistance, and did so again here on the 30th of December, and since then we continue. So you can use these trend line breaks once the trend line has been broken, when the market tries to bounce back, to sell against the bounce again and in the direction of the overall dominant trend, which in this case, as you can see here, is the downtrend, because we've had these big candles to the downside, and when you have these long red candles to the downside, and you go to the left, and you can then sort of count how many positive days they've just destroyed with a naked day. That tells you how strong the trend is. And you can see natural gas prices, basically every time they sort of spike higher, and we saw that in 2025 as well in March, that tend to come off again. And here we had a higher spike in December of this year, again, mainly also because not just cold weather, but there wasn't much volume going through the market here. And then we sort of came back off again. The question now is, are we heading down towards the 30 area here? We are, in my opinion, but the question is, can we hold here again or not? If not, we might actually retest the August lows again, because we've had this very sharp decline from this up move here. And you can see that when you do get a reversal to the downside, it tends to be quicker. It's what you said early on, Chris. Can you see here? I mean, it took us from August to December to go up. And then within 3 weeks, we're back down again, more or less where we were in September.
And these reversals happen, they can be brutal, can't they?
Yes. But again, when you look at the reversal, and going back to the example of stock markets before, you will see previous support being broken through, and on equity markets, we haven't seen that.
Exactly. We should move on to FX. I'm just conscious of time. Perhaps we'll just I'll just talk over the chart. Actually, if you dig out dollar yen perhaps to start with, because 2025 was a year where we saw the dollar really take a beating in the first half of the year, in expectation that it would continue to fall. The sheer sort of scale of the tariffs, the idea that there was going to be chaos within the administration, and really unsettled markets quite a lot, and the way you had these sharp falls, and then the way dollar yen continued to recover because of the election of the new prime minister, or the appointment of the new prime minister, raising hopes of fiscal stimulus, leading to that sharp turnaround, making it a very interesting year for this particular currency pair.
Yes, I mean, this is the weekly chart, and we can see exactly what you've just mentioned here, Chris. We had a very volatile 2024 coming back down again, and then the dollar appreciating again into January of 2025. But then last year, basically from January onwards into the April low, we saw the US dollar depreciate. And right now it's heading back up again, despite the Bank of Japan normalizing its monetary policy, because yes, they are hiking rates, but from an extremely low base. And I wouldn't be surprised if we were, once we break above these highs we saw in December, sort of 157.80 or so, to then go towards 160. But then, as has happened in the past quite often, we might get intervention again, don't you think?
I think it's definitely a risk at this point when it comes to dollar yen that we see maybe something stepping into Bank of Japan, because they're watching this very, very closely, and it's a key level, of course, for Japanese exporters. But it's an interesting one that you have dollar strength even as and yen weakness even as the Bank of Japan continues to hike. And then the other one to watch it, perhaps as we look into the second half of the year, particularly with the UK, is the way that the pound has done so well against the dollar of late. Once the budget was out the way, you've had that revival, and it now really, I think, hinges on whether you see a recovery, whether you see the Fed or the Bank of England cut rates faster, and where that really begins to sort of, if that gives the pound actually a bit more support against the US dollar. Clearly, the US economy does better than the UK, tech playing a part of that, major part of that, really. But you have seen this notable sterling strength that perhaps is sort of seeing a break of these two lower highs we've had, or potentially risking a break of those lower highs and bring a break out to the upside, Axel.
I mean, my view on the dollar in general is that it is going to weaken this year, and with that in mind, we can see here already that since basically the end of November, we've been heading higher with regards to cable. And I do expect us to go back towards the 135 and higher. And as you say, Chris, probably try to take out the July high from last year around 138. So I wouldn't be surprised if cable by the end of this year could continue to advance towards the 140 area or so against the US dollar. Obviously, there are caveats. I mean, if we were to come off here, where could we go to? Well, we've got quite a bit of support here around 133. And then really important support here, 132, these lows here from May and August. And we fell slightly below these for much of November, but then sort of recovered. But for me, this is a clear uptrend, and it's more likely to continue, at least in the short term, than not.
And it's a good point raised in the chat by a couple of people, really. Obviously, the Fed chair, the new Fed chairman, is likely to be, well, will be someone who clearly supports the White House's aim of cutting rates. The various names keep getting bandied around. I think Walsh is being sort of leading ahead of Kevin Hassett, who seemed to be the shoe-in towards the end of the year, to the point where he was being talked about as the shadow Fed chair. But that is probably the key thing, that you had Stephen Mirren, who is really Trump's boy on the FOMC. And if you look at things like the dot plot, you can definitely see him. He sticks out like a sore thumb, really, expecting far more rate cuts than anybody else. But there's definitely this idea that they're doing the White House's bidding. So if they do continue to cut faster, and Mirren himself said he expects 100 basis points of rate cuts this year, it probably seems a bit much, but that's likely to put pressure on the dollar and give further strength to both the pound and the euro. So it's particularly interesting. But the Federal Reserve element is one of the key things to watch this year. We know it's going to be someone, though, who is very much aligned with what the White House wants to happen. I think that's going to be very interesting for FX markets, isn't it, Axel?
Yes, I totally agree with that view. And what is interesting, though, if you look at euro dollar, perhaps because of the inflation data that came out of Europe, just today and yesterday, the euro is actually weakening again, whereas the pound, as we just saw, continues to rise. So I'll just put the pound back up again. So you can see the pound heading higher against the US dollar, but the euro weakening. And technically speaking, what is interesting is that we failed once again around 118, as we did back in July of this year, and also sort of end of July and at the end of September. So it may not look as positive with regards to euro dollar, perhaps because the European Central Bank might now, after all, perhaps cut once, which we didn't expect it to do this year, just a few months ago. And the question is, I mean, at the moment, we're talking about 1 to 2 rate cuts in the US, aren't we? The question is, will we see more than that? Obviously, that will have an impact on the US dollar in general as well.
Yeah, it's going to be very interesting in a world where you have a Fed that seems so compliant, if you like, with what the White House wants. It marks a definite change from the central banking era of the post-crisis world, where central banks did as they did what they thought was necessary and didn't listen to politicians. We should, without skipping too much over FX, because it remains important, I think obviously the driver of so much, we should look at cryptocurrencies, because we finally reached not necessarily a crypto winter. I was discussing this with someone this week. Are we seeing a crypto winter or just merely a pullback? Because you've had a particularly poor end to 2025 cryptocurrencies. We're constantly thinking they were going to rally, and then you've had perhaps a bottom forming. Stuff like Cardano is up 30%, I think, over the course of the past week or so, but still well off where they were in the high summer of last year. It is nothing like what you've seen in previous years when Bitcoin would suffer these huge declines, wiping vast amounts out of the price. And that's perhaps a reflection of the greater institutionalization, if I can put it that way, of cryptocurrencies, the way more and more ETFs and trackers are coming in. And there's one being filed this week from, I think it was Morgan Stanley or JP Morgan. So you have seen a slightly stronger start to the year. It's interesting the way, though, also that cryptocurrencies essentially another risk asset, and you don't get this particular divergence really from stocks. They don't act, I think it's fair to say, as a hedge anymore. They simply move as another risk asset that lives or dies by broader risk sentiment in markets. It's a notable moment that you've had a Q4 rally in stocks and in gold, and I think gold and silver have stolen a lot of the limelight from cryptocurrencies. You've had Bitcoin was meant to be digital gold, as Jerome Powell famously said earlier in the year, and it now looks like gold has become physical Bitcoin. Far more exciting, far more interesting. It's stolen a lot of that momentum, and there's the old-fashioned store of value taking some of the crown away from the new fashion, the newfangled store of value. But as the chart shows, I think, Axel, you've seen this tentative, probably is the best word for it, tentative recovery so far this year.
I mean, yes, as you say, Bitcoin did come off about 30% and went down towards the $80,000 mark. And what happened is basically unwinding of sort of speculative positioning. And we saw that mainly throughout this period here, the second half of November. And also ETF outflows really pushing the price lower, because what happened up until then is as long as we stayed above $100,000, psychological marker here, round number again, talking about round numbers, investors and traders were happy to buy Bitcoin just above that $100,000 level, because that's where it bounced off last time in June of last year. And then that didn't materialize. Then we suddenly went down very quickly because we fell through those lows. And we had all of this liquidation of mainly speculative positioning. That now gone means that the underlying flows, ETFs and also physical buying by retail clients manages to push the price back up again. And what is interesting is that this week it's done so in line with equity markets, whereas beforehand equity markets made record highs in December, and Bitcoin didn't, as you can see here. So from a technical perspective, right now, Bitcoin is a crucial point here, because basically we've got all of this resistance area, can you see here, around 94,000, 94,500 on the daily financial bet here. And I think on the actual Bitcoin underlying price is 4,760 or something like that. But basically yesterday's high for me is again an important point. Why? Because these previous highs could act as resistance. They did so today, so we didn't go any higher. But if we were to manage to break above these and close above these highs from this week, it's very likely that we're going to head towards $100,000. The question then is, can we break through these lows from June and also from early November and the psychological 100,000 mark? Because if we do so, we could then head back towards this 11th of November high. For me, that's a line in the sand, because if we manage to rise above that one, around 107,500 or so $1,000, then the reversal pattern here would really be confirmed, and we would probably be back up and head towards 126,000 and even higher. But right now, crucial for Bitcoin, can we break above these previous highs? If you look at other cryptocurrencies, I mean, Ether is in a similar position, but the resistance is slightly further away here. You can see that high from December ties in with the low from August. So I want to see a move above those highs, and ideally above the 10th of November high once again here, for us to reverse to the upside. And if you look, let's say just another one here, Solana, for example, you could see a similar pattern. So we're sort of folding, trying to go back towards the upper range of that sideways trading range we've been in for the last months. And the question is, can we break out of that range to the upside or not?
It's an interesting point for cryptocurrencies, really. We have reached the last 10 minutes of this, so I don't want to sort of skip through, but just briefly the things to watch perhaps as we look to what's coming in the next 12 months. Particularly this week, of course, and there's a question in the chat I'll come to in a second about Venezuela, but with the midterm elections looming, it does look like Trump's poll rate continues to get worse, and the risk is that pushes him to more overseas adventures. Venezuela most obviously, Colombia and Cuba mentioned, and of course Greenland, which markets do seem to be rather discounting at the moment, certainly acting in a way that suggests that they don't think it's going to happen, but it perhaps is not say a black swan, because you can't see a black swan coming, but a possible risk event for the year. I put the second one in to be a little bit controversial. Maybe the AI bubble fear goes away, not because something bad happens, but actually because the earnings begin to show that there's actually real strength behind it. So that's perhaps the point that it could be really interesting, is that people seem to be, as Axel was saying at the beginning, people seem to be quite bearish generally, or certainly very cautious. But if it actually transmutes into solid earnings growth, it could be a very interesting time for stock markets that admittedly have had a very strong start to the year after 3 double-digit years. They are, and I hope point 3 doesn't really contradict point 2, but they are certainly perhaps overdue. I should put that in inverted commas, really, overdue a correction in the sense that one tends to arrive at least every 6 months, really, perhaps more than that. And I think, yes, we've had a very strong start to the year, but the possibility of even a 10% correction from this point would seem, I think, fairly dramatic on a lot of indices, and would certainly utter a lot of apple carts in the short term. We are now moving to questions. We've had quite a few all the way through the chat. There was one question. Oh, do you see China export restrictions having an impact on the silver price through the year? So this is the news that China is restricting the export of silver. This is perhaps interesting, and it's perhaps why you've seen such strength in silver, and by extension in other precious metals as well at the start of the year. So I think that could be a very interesting development. It's a market that is not very much liquidity in it at all, and so it does lead to sudden dramatic moves. It's definitely one to watch to see if that begins to take hold in broader precious metals as well. And also, could we comment on how the recent US action in Venezuela and peace still in Ukraine would likely affect markets? The Venezuela one seems to be almost ignored aside from oil, I think, and maybe, to be fair, I think Venezuelan stocks actually are up. I think I saw the figure today, 170% since late December, but it's clearly not a market that most people are trading, so it's not best not to dwell on it too much. I think, well, the reports are that Venezuela has the largest oil reserves on the planet. That is OPEC's data, and it turns out that OPEC's data is merely people telling them that. So it's far from clear that it actually has to be the case. So it is perhaps something to bear in mind. But the idea is that if things turn out the way the White House would like them to, you would have US companies restarting production in Venezuela and causing more oil to flow, which would add to the supply glut narrative and potentially have a bearing on oil prices. That it's some months off at the earliest if it does happen at all. So I think what you're seeing at the moment with the volatility in crude oil prices is a sign that the market is sort of doing its thinking in real time, if you like. I don't think there's too much really across, famous last words, to gold, although I think you could see the flight to safety trade come back if this stuff around Greenland, which certainly isn't going away, does continue to rumble along, or turn into more action. It certainly is. I think as a report from the UK government suggested there's a 30% chance, I don't think it's meant to be shared publicly, but there's a 30% chance of some kind of seizure of Greenland. Last couple of questions. There certainly will be more scrutiny of cryptocurrencies, and I think that you're right to say that could have a bearing on how investors view it and whether it still retains that cachet. I think is an interesting one. Axel, I don't know what you think on that point.
Well, I actually believe that we're going to see more institutional adoption of cryptocurrencies, and therefore I do expect inflows into crypto ETFs to continue to rise, and that should support the price action. So I think the big crypto currencies, the Bitcoins, Ether, and so forth of the world will probably remain. But if you look at things like Dogecoin and other cryptocurrencies, which may not have the same sort of underlying structure, who knows how many of those will survive going forward? And I think a lot of scrutiny by governments, etc., and also by the regulators in different countries will focus on those now.
Yeah, I think that's a good question. Is MicroStrategy beginning to represent a risk to Bitcoin given the size it's holding? I think it reported a net or a paper loss of $17 billion. I think that's the other concern, is that it's becoming a bit a crowded trade, if you like. It's MicroStrategy clearly the first mover advantage. Others have tried to follow it without success, and it could be another risk there. I think that markets perhaps aren't including or pricing it, if you like, as much as they could. Just the last one, I think, before we wrap up, because time rapidly moves on the Nikkei, because we rightly unfairly haven't covered the Nikkei actually. So definitely one for Axel. Again, we had, is it a record high this week? Just eked out a record high today, I think, overnight.
Overnight, yes, as you can see here, but very marginal. But we failed. We didn't manage to close above here. So the question is, can we do so? If so, the next sort of round number might be 55,000 and then 60,000. But given this chart pattern here, I mean, unless we form a double top here and we come off and fall through these lows here, going back to the 21st of November. Again, it's the same low for all these markets. You know, we talked about these at the beginning of our discussion here on US markets. But as long as we stay above there, the trend is still pointing higher. And the fact that we've just tested this high today and haven't really managed to close above it, even though intraday we did so, doesn't mean it can't happen in a day or two, as we saw it with the FTSE, for example. So yes, Japanese stock market still looks strong. We saw the Kospi making South Korea a new record high yesterday, and Asia still looking strong as well.
Yeah,
in general.
It's a very, very broad-based start to the year, I think. I think if you've registered, obviously sign up for this, you should get the recording automatically. I think that's how it's sent through, so that you have it. We'll also, I think, share it more widely later on, particularly for those who may not have made the actual event themselves. Yes, Shrimpfred, I'm a bit flaggy bit too at 8:30, so I think we've covered a bit of a whistle-stop tour of markets. Thank you all so much for joining in. Thank you, Axel, for your charting expertise. Don't forget, you can read more of this on the IG website. You can catch us on Trade Live with IG. We'll be on YouTube as well and various social media. We hope you found it useful. And thank you once again for joining us, and best of luck for the year ahead.
Thank you. Goodbye.
Bye-bye.